Hey guys, welcome to the ValueHunt podcast. And today I'm super excited to be here with Rajeev, a master of the art of investing. And he has really a lot to teach us. So stay tuned and be focused because we have a lot to learn. So before we jump right into the questions, would you like to say a couple of words, Rajeev?
Sure. Thanks a lot, David, for having me on your podcast. I think you're doing some amazing work, and especially given your age, where you are, I think you're far ahead of all of us at this time. A little bit about myself. So I run a fund called Dudarshi India Fund. It's a US fund, and it invests primarily in Indian equities. And prior to starting the fund and becoming a full-time investor, I was in the corporate world for almost 2 decades. So during that period was a period when I was earning but also learning investing. And then over time, as I got to a stage where I felt I can now do it full time, is when I became an entrepreneur.
Wow, that's really amazing. And maybe you could give us a bit more context on your education and really the stepping stones to building the person you are today. Because I know you've had some level of success in investing. So I'm really interested to know the early steps and how you reached to where you are today.
Sure, no, absolutely. So I think a lot of who we are is shaped by how our childhood is, right? And early on, while I was in my school days, I used to have my grandfather and my uncle who used to do investing. And I always used to find it fascinating that they would read newspapers and invest. And it used to fascinate me that they could actually figure out things. And so when I went to my college, so I went to IIT Bombay for my undergrad. And so when I went to my college, I'm like, listen, I've done all the studies now. Now we can start focusing on investing. And like something like what you are doing. But unfortunately, my start was really bad because I went to IIT Bombay in 1991. And in 1992, India had this huge
Mhm.
stock bubble that was going on. There was a big, the stock prices ran up almost 5 times in 1 year and so on. And so any stock that would come on the market would immediately be lapped up. And so in 1992, I invested in many IPOs, which is initial public offering. And pretty soon the prices went to zero, right? And at that point, I realized that I don't know anything about investing and I don't want to do anything with investing. So this was a very early lesson that I got while I was in college. And for the next 10 years, from 1992 to 2002, let's call it, I was completely away from investing. For one, I had no money. For second, I said, I don't understand it. And then what happened is I gradually came in touch with Buffett, and I see Buffett photo behind you, which is fantastic. And you see behind me the two squishmallows of Buffett.
Yeah, exactly.
So I came to know about Buffett, and once you read about Buffett, either as Buffett says, either it immediately pulls you towards it or pushes you away. And for me, it was like, okay, this is what I was waiting for in terms of figuring out about investing. And so for the next, let's call it 5, 10 years, I kept reading different things about Buffett. And as you read Buffett, you know Munger, you know many other value investors. And as I kept reading about different articles from these masters of the craft, I just realized that this is who I want to be. And so in 2009, when my second kid was born, is when I realized that once I have enough money, this is what I want to do full time for myself, right? Because I enjoyed reading and I felt like because I enjoy reading, and it requires some introspection. So you have to say, oh, what is it that I want to do? Where am I good at? Why am I good at it? Right. And one of my sort of feedback to myself was, listen, I'm happy to sit and read. It is the easiest thing to do. And once I realized that, I said, okay, you know what? Where can I apply that? I said, oh, investing is great. I can apply it in investing.
Yeah.
So I gradually, in 2009, is when I realized that I would want to become a full-time investor once I had enough means. And in 2016, I was able to get to that stage. So at that point, I left my corporate job and then moved to become a full-time investor.
Yeah, so many interesting things that I would like to get into. But maybe starting from the beginning,
Uh-huh.
we could go back to your IIT days.
Uh-huh.
because for the people that don't know, IIT is the Indian Institute of Technology. So
That's it.
basically, the MIT of India.
Yeah.
And so I'm curious to know what were the early lessons that you learned. I don't know if you took an engineering degree,
Yes.
but what were the lessons you learned from that? And I know it's really actually hard to get into that school or that university. So could you guide us through the sacrifices or maybe no sacrifices that you made to get into IIT?
Right. No, it's great you're asking that question, David, because it allows me to relive those years. And frankly, it is one of the biggest achievement of my life to get into IIT. Even today, after having success in different areas, if there's one area which I felt I'm so proud of, it is getting admitted into IIT. And just for your audience, right now there are almost 10,000 seats when across different IITs in India, and there are more than around 1 million people who take this exam. So less than 1% admission rate. When I had appeared, there were around 2,000 seats. So now there are 10,000, so it's fivefold. At that point, it was like 2,000 seats, and there would be something like 200 to 400,000 people who would take. So very similar, around 1 to 0.5% admission rate. But what is interesting, what is not reflected here is the fact that many people would not even apply if they feel they're not ready for it, because they know how
Right.
difficult it is to get in. So the aspirant population is much bigger than the people who ultimately take the test, right?
Hmm.
So I think it's really, really competitive. And when I think about it, I was a very average student till my middle school, and only in my high school I realized, no, I need to study, right? And so when you are starting to realize you need to work hard, you are starting from behind. And so it
Hmm.
takes a lot of effort, because you have to overcome all the deficits you have in the past and then build on from there on your foundation to become.
Sure.
And so I think I would say those 4 5 years getting into IIT was just really hard, because I would just work all the time, effectively just work
Hmm.
all the time, study all the time, effectively, right?
Hmm.
Um, and I think different, many of my peers, once I went to IIT, I realized many of my peers were much more possibly gifted, let's call it, and they would get things easily. But for me, I had to work hard, and I'm very proud of that. Actually, at that point, I used to feel, oh my God, why do I have to work so hard? Right? Today, I feel that is actually a blessing, and the reason why that is a blessing is because it helped me understand that if I put my mind to something, I can achieve anything.
Hmm.
And so the willingness to work hard for a goal that you have set for yourself, I think, is one of the key takeaways I have. And since then, all the things that I have achieved is because it gave me the confidence that if I am applying myself, then I can achieve it. And the proof is in what I did at IIT. So subsequently, I went to, for example, do MBA, right, at IIM Calcutta. Again, one of the, it's called, basically, it's the 4 or 5 premier MBA colleges in India. And it was the same story where I said, listen, if I could do IIT, I could do anything else. And so I could do IIMs. And so I could then subsequently do many other things. So I think the big lesson there is, if you apply yourself, you can do anything, is what I took away from it.
Yeah, that's really amazing, and I resonate with that story because I used to be a very bad student, but then I learned discipline through sports, and I decided why not apply it to school, and then actually it turned out pretty well. So I'm happy that you had that experience, and hopefully I can leverage that into the future. There are again a lot of interesting things that you said. Firstly, I would like to touch upon a point which is really fascinating to me, which is the role of cooperation. Because investing is pretty much a single player game, but we still can't dismiss the role of cooperation and actually leveraging other people's ideas. Therefore, what do you think is the importance of cooperation versus competition in general, but also in specific to investing?
Yeah, no, I think while investing is very much a personal game, nobody understands company perfectly, right? No matter how much work you do, because there's always a lot of unknowns. And so, whenever one is researching a company, you want to be very willing to share your ideas with others, right? Of why you think a company is a good company. but that doesn't mean that your understanding of the company will resonate with the next person, right? And so
Mm.
what happens is, as we try to build a thesis around a company, you want to look at the same company from many different perspectives. And this is where cooperation comes in, because everybody has their own nuanced view of a company that you're researching, right? And you don't have to go to hundreds of people, because at that point you have a lot more noise, right?
Yeah.
But if you have a perspective on a company and you want to share, then you also want to look at what are the things you are missing, but also look at how other people are approaching the same company, right? And by having this, you are able to build your thesis, which is much more thorough and which accounts for different perspectives. And I think, frankly, people think that investing is very competitive, and it is, because everybody is trying to outperform the market. But it is also very cooperative, because it is when you look at each other's ideas and look at how they are approaching, is when you can figure out if you have a right situation or you have analyzed it in the right manner. The second thing I will
Mm.
say is that investing is slightly different in the sense that price is a really important element. So you might look at a particular company at a certain point and you might think it is compelling, but if the price moves, goes up, then suddenly it's no more as compelling, let's call it, right? So it
Mm.
depends on the situation. Many times, in fact, the price falls when the information is not there or when things are murky, right? That is precisely the time when most people will run away from a company. And yet, if you understand it, it will be the most compelling. So, unless many people are approaching the same company at the same time, and unless you're able to discuss that, you will not benefit as much from it. So, I think one of the things that I have found is I have been able to build my own circle of friends, people whom I talk about ideas, and they tell me about their perspectives, and I tell them about my perspective. And recently, I was meeting a friend, and he was saying, "Listen, he suggested an idea which I did not invest in," and he's like, "Listen, you don't look at my ideas." I'm like, "As long as I don't understand what that idea, why that idea succeeds, I'm not going to invest, because if I don't understand it, the first time it falls, I have no idea what to do, right?" And so, uh, I think it is very cooperative in the sense that you have to keep learning new things, and that is another area where working with others is very helpful. Because
Sure.
you might understand something, but you might not understand a different business. For my case, for example, pharmaceutical is something that I don't understand well. And somebody keeps telling me about pharma names. I'm like, I don't understand it. But that is how you build your circle of competence. So you don't say no. I mean, Buffett always talks about circle of competence all the time. But what people don't recognize about Buffett is that how he has built his own circle of competence throughout his life. He has grown that circle of competence. So you might have a small circle of competence when you start early on, but there is nothing that prevents us from growing that circle of competence. And we have to do that continuously. That is the game.
For sure. Yeah. That's really interesting. And I believe that nowadays we are very privileged because we can really get in touch with really high quality people and investors throughout the world that have unique perspectives on companies we may be interested in. So, how does one go about building that circle of friends of high quality people that can give you high quality feedback? Besides the common sense Charlie Munger approach of deserving it, because yeah, that's take we take it for granted. But yeah, how do you go about doing that?
I think it is first, you don't want to rush that process. That's what I will say. So the first thing is you need to put out quality work. And when people look at that quality work, many times people reach out to you. And I think it's always better, rather than saying, "Oh, I want to have quality friends." It is, as Munger always says, do good work and you will get good clients automatically. It's the same
Mm.
with building that circle of friends. You do good work, people see that work, and they then want to collaborate with you, right? Because fact of the matter is, anybody who is good only wants to work with other people who are good, right? So the first
For sure.
question you have to ask is, why should other people want to work with me, right? And they will want to work if they feel they will get something out of working with you. So that's one thing. The second thing is, you should be willing to share what your thoughts are, right? Many times in investing, what you will find is there are many ways to making money, right? So you might have a certain perspective on a particular company which may not be as aligned with somebody else. And I always like to look at other people and not say, not be a yes man, right? They should have their own perspective. And it's perfectly fine that their perspective is 180 degrees to my perspective. There's no problem with that at all, because that then helps me understand why is it that market is possibly mispricing it, right? So sometimes it helps me understand the market perspective on a company which I might not understand otherwise, and that is what I also should be doing to my friends ideas, which is to say, listen, I think this is why I'm not as comfortable, and they may not take it, which is perfectly fine. But by the dialogue, it helps you understand where each of us stand. And then I think in investing, I personally feel while circle of friends is very important, the willingness to read, the willingness to spend time by yourself thinking through things is the most critical aspect. And as important as it is to have a good circle of friends, it's as important to have a dialogue with yourself. It is very easy to say, because many times when you have a dialogue with yourself, that could be on the pen paper, or it could be just talking to yourself, which might look weird, whatever you want to do. But I think having, and many times I find, because the facts are never clear, you have to let the ideas marinate in your mind, let it be there and sleep over it. I love sleeping, so just sleep over
Yeah.
it as often as you have to, and then come back and see what do you feel about it. Also, I have found that for me, many times, if I don't have a clear perspective, I want to just make a slight move. Maybe if I want to buy 1% of my portfolio, I might buy 0.1% and see how that changes my perspective. Am I still liking it? Am I more worried about it? So just making a small move helps you decide whether it is helpful or not. So many different ways of achieving to that goal of saying, how do I get a little bit more conviction either on the positive or the negative side of an idea?
Yeah, for sure. And you already started touching on some points of your own process and how you think about investing. So why not ask you what's your general strategy and approach to investing, since you invest mostly, I believe, 100% in India, and what's the secret sauce to your past returns and maybe future returns?
Yeah, so I think one of the most important things in investing, where we started talking about, is your own thought process. Because frankly, the issue with investing is that, and again, many people have talked about it, our stock price goes up 50% from bottom to top in any given year, right? So there is a lot of variation that happens every year. And then the question is, how do you take advantage of those variations that happen? Clearly, the business prospects don't change as much, right? So what that means is the market moves much more violently than the business prospects do. And so the question is, if you understand a company, and so therefore you need to understand the company, and that is where the whole framework starts. And this again comes from Benjamin Graham, who said stock is nothing but a part ownership in a business, right? Once you accept
Sure.
that, and that is really what the critical part is, because if you don't accept that the stock is a part owner in a business, then you will do all sort of momentum trading, this, that, and the other, which is great for others, but it's something that I don't do. So I really am a value investor. And I think if you look at intelligent investing and what Warren Buffett has taught us, I think that's all you really need to know. And then you can keep adding more things on top of it. But really understanding that stock, when you invest in a company, buy a particular share, you're buying a company. So therefore, you need to understand the company, because if you don't, how do you decide whether you want to buy more or sell after you have bought? That's one. Second is that margin of safety concept, which is no matter how much you understand a business, you need to ensure that you are buying it at a price so that even if you are wrong, you don't lose money, and ensuring that not losing money rather than making money is a game that you are playing. Because when you lose money, your confidence goes for a toss. And once your confidence goes for a toss, it's very hard to recover that. So, and recently, Pulak Prasad actually wrote a very good book that your audience may find interesting, which is what Charles Darwin can teach you about investing. And again, he talks about that particular example there of how few good companies are there. And even if you are having a very good chance of being right, ultimately your success rate is going to be very low because the pool is so big. And so you want to focus on companies that you understand. And then also realizing, which I mentioned, that the stock price moves 50% from bottom to top in a given year for a typical stock. You always have to realize that Mr. Market, as Benjamin Graham talked about, is there to serve you, right? It is there to take advantage of rather than to treat that as something which is giving you information which you have to necessarily believe in. So I think those three pillars that Benjamin Graham taught, and which Warren Buffett espoused, and Charlie Munger espoused, I think those are ultimately the key pillars of investing that we use. I think what we find is that time and again people forget the pricing discipline. They take a good company and they think that company can keep doing very well, and it doesn't matter what the price is. And I think for us at least, having an anchor to understanding the value and always buying companies at a significant discount is what I think has been very helpful to us in finding opportunities. And we want to have a growth kicker. So many people sometimes distinguish between growth and value. We don't do that at all. We think when we are investing in Indian equities, we are taking advantage of the growth opportunities, because India is a growth market. But we want to buy companies at value,
Mhm.
value prices. And so we really are always looking for good companies at good prices. And that is what we are trying to do.
Nice. That's really interesting, and I've been quite interested in India, to be honest. But I don't feel like I have a specific edge. Obviously, you being Indian, and having access to maybe people that actually live there, or you can travel there and so on. So tell us about what's different between investing in other parts of the world and in India, and how do you avoid, let's say, the not so honest management and poor corporate governance that you might find in some businesses in India, which actually are not that good and can result in value traps, for example.
No, absolutely. I think that's critical. So I think, how is India different from other parts of the world from an investing perspective? I would say one aspect in which India is quite different is that India is still at a early stage of its growth journey, right, or its development. And we believe that India over the next decade, 2 decade, will be among the fastest growing, if not the fastest growing large economy. And so, what you then have is a huge tailwind at your back, and you really want to operate in areas where you have some advantage, right? To your point. And I think one of the big advantages that I have is that I have been investing in Indian equities for more than 2 decades now, in my own
Right.
personal capacity for a long time, and then starting the fund. So I understand that ecosystem. And I always tell people who are living in other countries, if they want to look at India, it is important to take advantage of other people's expertise rather than invest directly. Because to your point,
Sure.
there are always more nuances of investing in a foreign market which you will not understand. I mean, because I understand the Indian ecosystem, I will know what are the pitfalls. And one of the big pitfalls is what you highlighted, and that is management, right? Unlike in the US, which is my now adopted country where I live, unlike in the US, where the legal process is much faster, and therefore, if a management does something which is not right, they could be thrown out. In India, that process is very, very onerous. So, if you get into a company where the management is not looking after your interest as a shareholder, you have very limited recourse. And so, effectively, the only real recourse is to sell the company, take the losses if there are losses, or take the profits if there are profits, and find something else. And so, finding companies where the management interests are aligned with yours, not just in terms of the ownership stake, but in terms of the action they are doing and behaving, is really critical. And that you cannot decipher, that it is subjective information. You cannot look at one statement. You have to go through tens of statements, annual reports, and maybe at least 10 years of quarterly results, I would say, to help you understand how has the company behaved in different times. So there's a lot of work that goes into analyzing even one company. And that is why,
Right.
Buffett has always said, listen, I'm a better investor today than I was 20 years, 30 years. And Munger has always said the same thing about Buffett, that Buffett is a better investor in his 80s and 90s than he was in his
Yeah.
30s and 40s. And so one of the benefits, which is unique to investing, is that your knowledge compounds over time. And as your knowledge compounds over time, what I have learned about one company in India, I can now easily use that for a different company in India. And so to me, that is a huge advantage that I've built over time, that I have been able to take advantage of the companies that I understand, and now use that same template for new companies that I'm looking at. And so the analysis becomes faster. And frankly, there are a lot of mistakes that I've committed along the way, which allows me to say, okay, am I ensuring that I'm not committing the same mistake again? And one of the biggest mistakes in my mind that I have committed is not analyzing the management, and going many times for companies that on paper looks cheap, but they're not cheap, right? Because the management is not going to unlock the value for you.
Yeah, for sure. Yeah, so many, again, every single answer is
Yeah.
it's very valuable. But maybe you could expand a bit on what are the specific things that you look when assessing management that maybe other people really don't look at. Let's say more non-traditional strategies that you employ to get an idea or a scuttlebutt idea of how the management operates. Because at the end of the day, you can watch a few interviews and read the letters to shareholders, but you don't really know how they operate on a day-to-day basis. So yeah, what's your strategy?
Yeah, so I think I would first say that I don't need to know how management operates on a day to day basis. And frankly, it's information that is not very valuable. What I want to see with management is what they see and what they do. Are they aligned? Right? Many people are not willing to walk their talk. Um,
For
and
sure.
the issue with that is if they're not willing to walk the talk, then can I trust them? Like they can say, and we can ask question, listen, how will you unlock value? Or you have certain value here. Why aren't you, or why aren't you growing faster than your competitors? As an example, let's see how they react to it. So one of the issues that you will see with management in India sometimes is that the business was started by like in India. One big difference versus the US is that a lot of companies are promoter owned and promoter led, right? Which means that maybe the parents or the grandparents started a company and ultimately it was passed down the generations, and now let's say grandson or granddaughter is running that company, right? They may or may not be that passionate about that business. And so
Sure.
they are like, listen, here is my cash cow. Let me use this cash and have a good life. Now, that is good for them. But for a shareholder, effectively, there is hardly any growth. There's not enough value creation, right? They can have a wonderful life for their life, right? But as shareholders, we are there to earn returns, right? Now, so there we need to see some drive in the management. And unfortunately, it's not what they are saying in the shareholder letter. It is what they are doing. And that is what
Sure.
the saying versus doing thing that I was talking about earlier. You cannot judge based on one report. You have to look at, let's say, if I'm in 2024, I want to look at what they said in 2012 or 2014 and what they did subsequently for the next 5 years. Did they actually follow through on their actions? And the interesting thing with investing is that investing is a long-term game in general, right? And so I don't really need to know what they're telling me today. All I have to do is go back and see historically what they have said and then what did they do subsequently, right? And
Hmm.
that is the biggest marker. But that is also a very time-consuming process. It's not
For sure.
easy.
Yeah,
Yeah.
yeah. Yeah, it's a lot of work, and as you said before, you have to be really passionate and curious to be like this investigative journalist and really figure out the details and maybe reach out to people and yeah,
Yeah.
basically using all the means you have to get information. That leads me to the next question, which is actually how do you collect relevant information? Obviously now it's easier because of the internet, and you can just text a friend in India or something. But how do you collect relevant information for Indian companies that maybe don't have as good of a structure like the SEC that forces them to report yeah, basically everything. So how is that process for Indian companies?
Yeah, so actually, the reporting of information is pretty good in India. Um, I mean, I compared how the reporting is in India versus US, and you can question sometimes accounting policies or disclosures in some situation, like what is your debt maturity profile and all that. But in general, the reporting and the disclosures, right, have improved continuously. And right now, a company is supposed to submit any relevant information to the stock exchanges. In India, there are two main stock exchanges, Bombay Stock Exchange and National Stock Exchange. And you can go to their websites, and they're supposed to disclose the information there. And you can find for any company any information very easily on those websites. And anytime if they're meeting investor, they have to disclose whom they're meeting. If they're sharing any non-public information, they have to share that public and non-public information to everybody. If they're saying that we are going to walk through a presentation, they have to share the presentation. So everything has to be disclosed. And so the disclosures are really good. I think the bigger issue is not the disclosure of information. And information, as we all know, we are all actually overloaded with information at this point rather than
Yeah,
underloaded.
for
So
sure.
we have no issue in terms of getting the information. I think the issue is how do you then filter through the information? And what is interesting is in India, SEBI, which is the equivalent of SEC in the US, has made companies disclose more and more information. So even if they have any tax dispute, they have to disclose. So it is becoming more information. And when you are trying to filter, what you have to say is, how is this information going to impact my thesis? And if it doesn't, you can move on, right? So today, the amount of disclosure is much more than is really required. And I would say it's more of the filtering. And that filtering takes some time for you to figure out what is relevant, what is not. And the more you understand the company, the faster you can figure it out. The less you understand, the more you have to go through the disclosures to understand whether it is relevant or not. So I think that's really building your circle of competence. And frankly, if I'm, let's say, looking at pharma, I want to look at more information, because that
Right.
more information helps me understand what is useful, what is not. It might be more time consuming, but that is how you build your knowledge, right?
For sure.
And circle of competence. Yeah.
Nice, nice. That makes me really curious about your previous experience in investing in India, and
Yeah.
maybe you could, let's say, give us a bit of a lesson on maybe a case that went really well for you and a case that went really poorly, and the lessons you learned from those. Because yeah, I feel like it's always better to learn from specific examples, like Graham did back in his classes. So why don't you play Graham today?
Yeah, no, no, I can play Graham. I know we are nowhere close to what Graham did. But just one question is, if I take a individual stock name in India, how likely is it that your audience will know anything about that? And how much detail you want me to go into that?
Oh, so maybe you can just use examples where you already ended the positions. Maybe that's easier. I feel like my audience is not too India savvy. But if you don't feel comfortable talking
I
about
mean, I'm
current
happy to
position.
talk about it. I don't have. I'm just trying to ensure that we don't. I don't give a case study which people find boring.
Oh,
That's what I
okay.
was asking.
Yeah,
Yeah.
so I would assume that everyone that is watching this knows nothing about India.
Yeah. Okay. Yeah. So that's, I think, a good way to phrase it, because that way at least I can go on in a little bit more detail. And then
Mhm.
if I'm going into too much detail, let me know and I will try to come to a higher level. Right.
Yeah.
So all the countries have a bank, and so I will give
Mhm.
you one case study on a bank. And again, a lot of these case studies that I am going to talk about are possibly case studies that are also available on SumZero.
Okay.
SumZero is a platform where I have been posting case studies. And what I will do is only take those case studies which I've posted publicly. So that way, at least there is no problem. If somebody wants to read more, they can go there and read about it. Right.
For sure.
So I'm going to take a case study of a bank called Ujjivan, small finance bank. And I did a case study on this. And so Ujjivan Small Finance Bank is basically a bank, but effectively it started as NBFC, non-banking financial company. So effectively non-banks, right? I'm assuming in Portugal you have non-banks.
Yeah, maybe at a European level, like
At
Revolut
European level.
is.
Okay.
Yeah.
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 So effectively, so these non-financial companies also give out loans, but they are not governed as much by the banking regulation. They are governed in India. They are governed by the Indian Central Bank, which is Reserve Bank of India, and so the central bank governs all of them, but possibly governs the banks a little more strictly than it does for the non-banking financial company. And then in the non-banking financial company, you have the you have what is called as MFIs, microfinance institutions. Now, a microfinance institution is where you are giving out loans to the bottom of the pyramid, where people don't have enough income, they don't have any
Yeah.
collateral. And this model was pioneered way back when by Grameen Bank in Bangladesh. So, and
Yeah.
that is how this whole process started way back when. And it was introduced in India in the early 2000s, where multiple such MFIs, microfinance institutions, came into existence in India. One of the big challenges in India has always been that the bottom of the pyramid people did not have access to credit, right? And as we
Hmm.
all know, many times you cannot start your livelihood if you don't have access to credit. So if you get a buffalo or a goat or a chicken, you can start your whole livelihood through that,
Yeah.
right? For example, or you can set up a small kirana shop. I don't know, I mean, a small shop, very small shop,
Yeah.
but you can sell out basic necessities for people, right? So you don't have to walk 20 kilometers or 20 miles to get your stuff. So you put it in the village. So those type of basic things, right? And so
Right.
issue always with such shops or such businesses is they do not have any collateral. Now, if you don't have collateral, how does the any institution give you the loan? And tomorrow you don't repay the loan, what happens? You don't get paid, and you have huge delinquencies, right? So that is where the whole MFI, microfinance institution model, came in, again based on the Grameen model. And the way it works is that multiple such borrowers come together and they form what is called as a joint lending group, JLG model. Okay, joint lending group. And the idea
Hmm.
there is multiple people come together, and therefore, if one person defaults, the rest of the group is supposed to repay that person's loan. So
Wow.
even though there is no collateral, these people who are supposedly, hopefully, friends of each other will help each other out when one person has a difficulty. And through that mechanism, you are able to ensure that the financial institution is able to get their money back, whatever they are promised, right? As you can imagine, because there's limited collateral, the delinquencies are much higher, right? And so
Right.
Ujjivan started its journey in 2004, 2005, when Samit Ghosh, who was the founder of this company, started it as a non-profit organization, NPOs, right?
Hmm.
Or NGOs, non-government organization. And then gradually over time, as this model scaled up, a lot of different private equity and foundations invested in Ujjivan because they felt this is a good way to alleviate poverty and get the livelihood of the bottom of the pyramid started. In around 2008-9 is when RBI said, RBI again, central bank said, listen, we want to bring these all these institutions in this what is called as MFI, microfinance institutions, so that it can be a formal way for the institutions to give loan to the bottom of the pyramid. And then in 2015, 2014-15, they said these microfinance institutions, some of them can become a small finance bank. And the difference between a bank and an MFI is that an MFI, you have to borrow from the market, right? You have to borrow from the market and then give out loans to these bottom of the pyramid. So the problem with
Hmm.
that is that you're always dependent on borrowing from the market or from the
Yeah.
banks. If tomorrow bank says, listen, we cannot lend you, then the MFI is no more into business, right?
Yeah.
The business is done with. So you have to ensure that the banks and the capital markets always have faith in you, right? And because the liabilities are a really critical part to be able to create the assets. So,
Yeah.
and that was always a problem. And that is where RBI said, listen, let's create a small finance bank so that you can also raise your own liability through deposits. Is it too much of a detail,
No,
David?
no, 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 no. I'm listening. I'm just trying to understand the details. Yeah,
Sure.
yeah.
No, yeah. So it could be a little bit onerous here, but okay. So they created this small finance bank, and Ujjivan became a small finance bank in 2017. Okay, so they were a microfinance institution, and when they became a bank, they also had one more entity, which was the Ujjivan Financial Services Limited, which was the MFI. And in 2020, we all know COVID happened. And guess what? When COVID happened, the delinquencies went through the roof because there's no
Right.
collateral, and the stock price went down dramatically, right? And by the way, before that, and this is an example where I built my circle of competence in MFIs around that time frame because I never really
Hmm.
understood it. I knew the broader NBFCs, but I did not understand MFI as such, and I always was very scared of MFIs because of the reason I described to you, right? But gradually, as I looked at it, I said, no, you know what? They go through these periods where things are really bad, but then they also go through periods where things are really good also, right? So it's much more volatile, if you will. And so in 2020, 21 is when 21 is when I actually put out a case study on Sum Zero for Ujjivan Financial Services Limited, which is the MFI. And effectively, the thesis was that delinquencies are higher today and the credit cost is higher today, but over time that cost will come down. And this is ultimately a pretty powerful business model because the interest spread between where you're lending out and the cost of deposit is very high. And because of that, you should be able to make good money once the delinquencies come down. That was the basic thesis, right?
Hmm.
And then also there was another thesis that the parent of Ujjivan Bank, Ujjivan Small Finance Bank, was also separately listed, and we said it will reverse merge into the bank. And so that is what has played out over time. And so we have done since our posting, we have done like 4 times in the last 3 years. We have done very well with that,
Wow.
and we have done well because what we thought would happen has sort of played out, right? So I will pause there, see if you have any follow-up questions before I move to my mistake. I think should have talked about my
Yeah.
mistake first, but that's all right.
No, no, that's awesome. Yeah, it's a pretty interesting case. So I would love to ask you because a lot of really good investors I know personally actually like to invest in companies that are temporarily impacted by a short-term event that really suppresses the earning power, but over the long term, it's still a business that will generate a lot of cash flow. So my question is, how do you find such companies? Because on a screener or when you look at the stock exchange from A to Z and you screen those companies, they might seem like poor businesses because they are actually losing money, maybe. Therefore, how was the process of actually finding that idea?
Yeah, so I think I typically have found financial services as a good hunting ground for myself. And the reason for that is because I feel like I understand financial companies better. And the reason for that is I have worked in financial companies for
For
almost two
sure.
decades in my corporate world, right? So I was at Goldman, Bank of America, JP Morgan, S&P Global, whatever, right? So I worked at various companies. So again, this is your circle of competence thing. And so I felt like, listen, this is an area which I understand, and therefore many people actually always say, listen, they don't understand financials, right? And
Yeah.
so there are certain people who say they don't understand financials, including David. And then the
Yeah.
second one is that I have had certain advantages there, right? So you always want to play unfair games in
Yeah.
investing.
Yeah.
You want to play
Exactly.
fair games. It's too hard then. So one of the unfair games is that because I worked, I also was in risk for a long time, right? In various Wall Street firms. So I felt like, listen, I understood something. But I would also say the way risk is done on Wall Street versus what we do is very, very different. So it's
Mhm.
not comparable, but at least I had some understanding. So I think that was helpful. And so how did I go about finding this is, I initially first used to look at NBFCs, the non-banking financial companies. Then I expanded my horizon to look at other types of NBFCs and banks. And then I looked at MFIs, and MFIs came pretty much at the end in 2020, right?
Mhm.
When or 20, yeah, I would say 2021 somewhere I started looking at it, because till then I was like, I will not do it because there is no collateral. When there is no collateral, you don't make any
Yeah.
money. but
Yeah.
but the facts told me otherwise. So I'm like, listen, why do I have that particular bias about saying, no, I will not do it? Let me actually take a look at it. So the point is, most of the things that we do don't lead to anything. Very occasionally, you will find something that is compelling enough that you can understand enough and you are willing to put some money to work, right? But most of the
Mhm.
time, we are continuously searching broadly and
Right. Right.
coming up with nothing.
Yeah, yeah. I was just the other night looking at First North Growth stock exchange from Sweden,
Uh-huh.
and I spent like a couple of hours looking A to Z, and I reached to like V or something, and I found nothing, and I was like, what a waste of time. But at the end of the day, I really looked at hundreds of companies in those hours. So
Yeah.
it's really that process of learning and expanding your circle of competence in a hard way,
Yeah.
and maybe next time I look at one of these companies, I find I already understand a bit. So yeah, that's actually something that resonates with me. which is really interesting. And then, since your position has uh, had a 4x over the last 4 years, have you decided to trim, sell, or yeah, do you still hold that
So
those
that's interesting.
winners?
I've not trimmed it at all.
Okay.
And so I've kept it. It is among the top five positions, both in the fund. And the reason for that is I think the business prospects have improved dramatically as well.
Hmm.
And again, it's not
Right.
expensive even after going up that much.
Right. Right. Right.
So what is
Okay.
interesting is that one has to always rewrite, re-underwrite your positions, right?
Hmm.
And if anything, I've only bought as things have gone up, as the prices have gone up, because I felt like the business is improving even faster. And so I think the point is, you cannot say because the prices have gone up, now I should take the money, right?
Yeah.
You
Sure.
have to say what you think the business can do over the next few years. Where is the price compared to what you think it can be in the next few years, and see if it is still worth holding on to it. And so far as Ujjivan is concerned, we feel that the business is doing all right. So I described to you small finance bank, right? Ujjivan became a small finance bank. Now they are going to become what is called as a universal bank. The small finance will be taken out, and they will be called Ujjivan Bank if they get that
Hmm.
license. It's another 2 years process. It will take some time for them to get there. We are in no rush. So I think the
Yeah.
important thing with investing is have to have the patience, because we invested
Sure.
in 21, 22. Like there were periods. By the way, I will tell you, 2021 we invested. 22 March it actually fell by 20-30%. We bought more
Okay.
after from our initial investments, and since then it
Yeah.
has been on going up and up. So it's not like it became 4x. Pretty much it fell by 20-30% after we invested. Like, where did we get involved in, right? So we were concerned,
Yeah.
but no, I think
Yeah.
that's
Yeah.
what happens. And one of the things we have found for ourselves is conviction also comes over time. Like if we invest in 2021, our conviction on that particular position will be different than it is today, because we have been with the history, we have seen the history of the company, how it has evolved in that period.
Mm.
We've seen the management, how they have performed, what they're saying versus what they're doing. All those things are very helpful. Even though when we first invested, we did a 10-year sort of track record in the past, and we felt good about it. But it's very different when you have money on the line versus when you don't have money on the line.
Sure.
And I think so that was helpful. If
Yeah.
you don't have any further questions on Ujjivan, I will move on to the next, because I am also eager to talk about my misses as well, which is as
Sure, sure. Actually, I just have one small follow up,
yeah.
which is that I would like to know if you have a certain cap for the cost basis of as a percentage of your portfolio for any given position, because from my experience, when I buy something, it usually goes down 10-15% after.
Yeah.
So I tend to buy incrementally, so I don't build a full position right away, which is good because then I'm able to lower my cost basis. And this has happened this week, and that's why it's so fresh in my mind. So my question is, how do you manage that? And for example, in this specific case, you said it dropped 30% or 20%. So do you always leave some room for adding more, or do you not have a specific cap and you add just when you feel it's even better opportunity?
Yeah. So one, we don't buy a full position initially. We never do,
Hmm.
because, as I said, we are never as confident when we start a position. The confidence
Hmm.
comes over time as you see
Hmm.
management in action. The second thing is, if I like a company at X price, then if it is 0.9x, I should be liking more. Otherwise, I was mistaken, or facts have changed. Those are the two reasons, right?
Right.
If facts are the same, and you the prices have gone, if you're not buying, then you somewhere did not have enough confidence when you initially bought it, which is fine. But it is a good indicator to you that you should do more work subsequently, right?
Sure.
In new ideas. And so we actually bought a lot as it fell. And the reason for that is very simple. As it fell, we felt not very, we felt comfortable that if that it is an even better bargain today, right? And
Hmm.
then as it performed, we again added even at much higher prices, because we felt
Hmm.
the business is even better than what we initially underwrote, right? So I think we bought both as it fell, and we bought as it even went further up. In
Right.
terms of your question about the position sizing and where do we limit ourselves, we almost never start with like first we have given ourselves a lot of flexibility in terms of what is our maximum position, and we don't worry about the cost and all that because that is meaningless in our mind. What we say is our position, one position, we don't want to make more than 30% of our portfolio. So we have a very high bar where
Right.
we will not allow a position to run. The reason cost is not very relevant for us is because ultimately what we want to say is, has the position become too big as part of the portfolio? And if it has, then we want to trim it down, right? But if it
Hmm.
has not, it doesn't matter what we bought it at. What is much more relevant for us is, given the current price and given how our portfolio looks, is this position too big for our portfolio? And therefore, should we do something with it? So that is
Okay.
how we think of it. And if something like, as I said, it became 4x and still it is in the top, I think it is top three position in the fund right now, but it's still not number one position because something else might have done even better.
Sure. Sure. Yeah. 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 I bet it has done better because you said number five.
No, it is in the top three, I said.
Okay, top three. Yeah. So yeah, that's pretty cool.
Yeah,
I hope to have that
I know.
in the future.
You need to
Yeah.
get lucky on those things. You cannot. Yeah. So.
Yeah, yeah, yeah. But anyways, now I have no more follow-ups, so maybe we could move on to the yeah, to the mistake.
Yeah. So, okay. So, I will also talk about my mistake. And I was thinking about a different name, but I just realized, what? I should talk about the name from the MFI segment itself. So,
Oh, cool.
microfinance. Because I think that basically demonstrates why sometimes, even though you understand the sector well and you feel, or not understand the sector, you basically understand the sector, and yet uh, one company can do very well and another company may not do as well, right? Um,
Sure.
so there's, and I don't know if I have a case study of this in some zero, but this is something that we did not make money on. So on one company we made money, on another we did not make money, and that's why I'm sort of talking about it. And this is a company called Satin Credit. It is also NBFC. It is not a small finance bank, so it did not get the subsequent license from RBI.
Yeah.
Uh, Again, very cheap. We are always attracted to cheap companies. So it was very
Yeah.
cheap when the microfinance sector went through the crisis because of COVID, and we felt like, listen, this is so cheap. We should be making good money. It was trading at maybe like less than 0.5 times book. We felt that this company can do well as the economy recovers and this segment recovers. Um, the two mistakes we made. One mistake that we made there was, I mean, I think in terms of the business, I've already described, so there is nothing really to describe there. But the
Hmm.
one concern we always had was there was always some doubt about the management.
Hmm.
Are they being forthright, and are they doing the right thing for the shareholders? And this is an example where I will talk to different people, just as I will talk with Ujjivan, and people had doubts as they did with Ujjivan, but they had more doubts with Saturn, let's call it, right? And so, effectively, given the concern with the management, and the fact that the pain looked like it will continue for a few more years, so I got impatient. So I made two mistakes here. One, I got in too early, and then I did not keep my patience to continue with that position. I knew that the business will not recover very quickly, right? Um, and the reason I did not have the patience to continue with it for the long term was because I always had some doubts about the management of whether
Sure.
it will do the right thing. And no matter how much you look at the history, you're always investing in the future. History is a
Yeah. Yeah.
guide. Future is what we are trying to figure out, and future is always uncertain, right? So anyway, so effectively, we invested in this company and then we sold it. I will say within a year, maybe I don't know exactly, but let's call it 12 months, plus minus six, right? So between 6 and 18 months, we sold it, and effectively we did not lose money, but we did not make money. Had we held on to it for, let's say, 2 years plus, I think it would have been another two, three baggers for us, right?
Wow.
So we sold too quickly.
Yeah. Yeah.
The mistake is not just in initially feeling getting too early, but then selling too quickly as well. So I think there were mistakes on both sides here.
That's pretty interesting. Why you qualify it as a mistake? Because is if you really didn't feel as comfortable with the management, uh, wasn't it, let's say, a rational decision to actually get out? Because yeah, you can say in hindsight it was a mistake because it went up 4 times. But
Yeah.
for example, in my case, I invested in an oil company in the US, and it actually was one of my best investments. But I classify it as a mistake because I really knew nothing about it, and I relied on other people's conviction. So even though I made money, it was a mistake. So I would like to ask you if you still feel is a mistake just because it went up, or the management was actually better than you expected.
I think it is both. I think management has worked out well. See, one of the things is that when we look for financial companies, is we always realize that financial companies you can never be sure of any company, let alone financial companies, right? There's
Hmm.
always too many unknowns. But but the management was significantly. It is a promoter-led company, right? So promoter always was going to do the thing that would benefit him, right, and through that possibly benefit the shareholders.
Right.
Uh, but I think if I think about it, did I feel that I sold out at the right time? I would say yes. The reason I sold out at that point was not just because I was uncomfortable with the management, anything, but what were the other opportunities that I was seeing. See,
Hmm.
it's always
Yeah.
the way to judge our decision making is based on our opportunity, right?
Yeah.
And what are the opportunity costs that we have? So I would say at that point I was seeing many other opportunities that were possibly more compelling, given my suspicion, not suspicion, but given the unease I had about the management, right? So to that extent, I don't think it is a mistake. To the extent that the
Yeah.
price has gone up, and therefore I consider it a mistake, I think is why I'm saying it as a mistake.
Hmm.
But it's very hard for us to go back and think about what exactly were we thinking. But I know in terms of when I sold that particular position, and since then how the portfolio has done, I think we might have just done as well with the rest of the portfolio as what this particular company did. So if you look from an all opportunity perspective, I don't think it was a mistake.
Cool.
But I
Cool.
think the lesson from here is, when you are uncomfortable with the management, the probability that you will continue invested in that company is very low. I think that is the key lesson, because
Yeah. Yeah.
you will always sell out at one point or the other for one reason or the other. That's the point.
Yeah, for sure. That also works for me because I also invested in this company that I wasn't so sure about the business model itself, but I knew it was undervalued. But I said like I wouldn't like to own this in a crisis or whatever, so I might just better sell at a small profit right now. It actually went nowhere, so it wasn't like a mistake. But yeah, I feel like I can't get enough conviction to hold a company for the long term. Ideally, I don't know, 10 years or forever, whatever. If you don't really have trust in the management and as well as the business model itself. So
Yeah,
yeah, great insight. Thank you.
sure.
And now I have, maybe we are already close to the
Yeah.
1 hour mark that we had set before, but I have a couple more questions. So if you are willing to, we could jump into them. Otherwise, we can.
No, I think we can go ahead. No problem. Yeah.
Okay, cool, cool. So yeah, my follow up question is, when you get such extreme successes like the first case that you talked about, how do you keep your humility and expectations in check, as well as those of your clients? Because I assume that your clients are human, just like me, and we look at past performance and say, "Oh, okay, so this will continue over time." And all of a sudden, if there's a bad year, everything, let's say the expectation goes to zero or negative. So yeah, how do you manage that?
So actually, a few things. One, we don't talk about performance on a quarterly basis at all in the fund. Um, we tell we only discuss our performance once a year, and in almost all communication I send out, I always say even once a year is too much, too often for
Hmm.
me to discuss the performance. What we tell them is, while we have done very well since our inception, they should be looking at our inception, at our returns and our performance over 3 to 5 years. And anything less than
Hmm.
that is too short a period. So,
Right.
one, I am training my investors to think long term. It's
Right.
very
Right.
hard, very, very hard. And we did very well last year. So a lot of more money has come in this year, as you would expect, in the fund.
Yeah. Yeah.
Because,
Yeah.
people chase past performance all the time. There is never any doubt about it. But at least through my actions, and one more stats I will give you, which I think tells you that we at least have been successful in getting our investors aligned with us, is the fact that since our inception, we have not had no redemption. So nobody has withdrawn
Wow.
money, right? Even
Congrats.
in years when we were not doing as well. Okay. So I think and again, not doing as well and then doing very well. So overall, we have done very well as compared to the indexes and so on. Um, but I think what we have continuously tried to tell our investors is, if you are in the business of investing for the long term, is the only time you should come to us. If you are investing
Mhm.
for the short term, or you think we can beat the benchmarks every year, then we are not the right person for you. The second thing is, we actually assess our investors for that. If we feel that somebody will be very volatile, we don't want them in the fund. And we have that privilege, right? We have the privilege of saying, listen, this is a long term fund. Like, somebody can say, no, no, we are long term. But if we, and when you discuss with them, you figure out, like, if they're saying, oh,
Yeah.
do you have a stop loss? I'm like, well, why would I have a stop loss? Right. So
Yeah.
they have
Yeah.
a trading mentality. And when you know that, you're like, okay, this person may still say, no, no, I'm investing for the long term, but maybe they will not think that long term. And so we want
Sure.
to filter out our investors for that. And then how do you keep humility was the other question. I think
Hmm.
the only thing is that you will make mistake in investing. There's just no other way. And
Yeah. Yeah. Yeah.
one of the things I mean, I always think so often about why Buffett and Munger organized themselves the way they did. And Buffett, being as smart as he is, the fact that he has Charlie by his side was enough to keep him humble, because Charlie will say
Yeah.
things the
Yeah.
way he wanted, and he did not care whether Buffett liked it or not. But I'm sure Charlie would be nicer to Buffett than to other people. But still, Charlie could be pretty abrasive at times, right? And so
Yeah. Yeah. Yeah.
one of the reasons why Buffett had Munger was to keep him humble, because Munger was so smart, right? And he also knew that, and no matter how good you are, you will make mistakes. Buffett has made mistakes. All of us makes mistakes. And so one of the things which I always like to do, and in our annual letter in 2023 we did that, is we for the first time talked about our mistakes. And we were really, and I started the fund in 21, so I didn't want to talk about mistakes too soon, because you don't know if it's a mistake or it's just Mr. Market testing you, right? But after we had a good year, I'm like, this is the right time to talk about our mistakes. So
Yeah.
as we have learned from Munger, it's very important to rub your nose in your mistakes and talk about what were the mistakes, so that people understand that we will make mistakes. And it's important to talk about them when you are doing well, but equally important to talk about them when you have not done well. But once you have created a track record, I think it's a lot easier to talk about mistakes, because people
Sure.
know that you will not always do well, right? You will always, and I keep saying that, listen, we have done well this year doesn't mean anything about what we will do next year. But over time, over the long term, hopefully we'll do well.
Sure. Sure. Yeah. That's great advice, and it's something I'm really interested on, because it's really easy to for our egos to get inflated. So that's also a reason why cooperation and talking with other people, and having really honest friends, it is really useful.
Yeah.
So yeah, thank you for your answer. And then another, let's say, more soft skill of investing, which is actually a hard skill in my opinion, is the aspect of managing our own emotions, because obviously we are human. Even though we aim for rationality, we still feel our emotions. So what are the strategies you use to, let's say, keep rational and deal with your emotions and use them to your advantage in investing?
Yeah. So, I mean, I think first is, we are all humans, as you said, so we will all have emotions. And one of the ways of ensuring that emotions you can take advantage of rather than be impacted by, is to ensure that you are always introspecting yourself and saying, how am I feeling right now? Am I feeling
Mhm.
excited? Am I feeling dejected? Or I'm sort of in my normal state. And even whenever you are either at the extreme on the happy side or the downside, you want to ensure that you are not taking a lot of actions, right?
Right.
In general, actually, one of the ways that we have trained ourselves is not to take too many actions, even if we are normal. So we don't buy
Yeah.
sell that often. So it's very infrequent that we are making buying and selling decisions, which actually is quite helpful. People say, "Oh, you are in the US, you are investing in the Indian markets. Are you awake the whole night because of the time difference?" I'm like,
Mhm.
"No, I'm sleeping fine." Right. And the reason I can do that is because I will look at the market. If I have to put a trade, I will put a trade and go to bed.
Mhm.
And I will see if the trade actually executed or not or whatever. So I'm not watching the market. And in fact, that's a huge advantage I have as compared to other fund managers who are watching the market. So one of the ways of avoiding being too emotional is to watch the market, right? So we
Yeah.
don't watch the market. You initially make the decision, and if it happens, great. If it doesn't, tomorrow is another day and another set of opportunities. The
Right.
other thing is you always need to know what you will buy, right? Just because
Mhm.
something is down 10% doesn't mean you will buy it, right? Or 20% or 30%. You need to figure out whether that particular stock is the best opportunity you have. So you have to have that record of which company at this point looks the most compelling, right? And
Mhm.
which looks the least compelling. So you should be able to act both on the buy side and the sell side if you have to. But
Mhm.
most of the time, you're not doing either. So point is, while Mr. Market as an allegory, I think is wonderful by Benjamin Graham, you need to ensure that just because somebody is becoming cheap is not necessarily the most lucrative for you. And you need to understand
Yeah.
that very well. And I think having the discipline to understand that and then buying among the top compelling ideas and selling among the least compelling ideas is the only way that you should act. And we basically discipline ourselves to do that.
Yeah, that's amazing, and I actually have a rule for myself that I cloned from Monish Pabrai, which is that I only trade when the markets are closed.
Yeah.
So yeah, you don't have that problem because the markets are always closed when you're awake. So that's pretty funny.
No, it's
Um,
not true. I mean, just to clarify, I will put the trade when the market's open, but just at the early stages. So I'm not watching it yet.
Yeah, 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 exactly. Yeah, basically
Yeah,
during your
pretty much.
working hours, you're not really able to watch the ticker symbol going up and down.
Exactly. Exactly.
So yeah, that's I find that pretty interesting. And I was wondering because I saw some of your questions on at the Berkshire meetings, and Munger and Buffett answered them, and they were pretty interesting questions. I recommend the viewers to go watch them because there's some funny things too in there. But I would like to ask you about your mentors, and maybe if you could share with us some stories or interactions you had with people you really admire.
Sure. Yeah. So, I mean, I think just on the questions, people can go to our website, dodarshiadvisors.com. And I'm assuming David will put that note. There are
Yeah,
the
sure.
two interactions that I've had with Warren Buffett in his annual meeting are there. And I think I actually feel those were great opportunities to ask Warren some of the questions that have been on my mind. And I think as much as we think Warren Buffett is a great investor, I think he is even better human being and even better at interacting with people and making them feel good. And you will see in both the answers, I just felt so good asking those questions.
Yeah,
I was very
I can
happy.
imagine. After Warren Buffett offering you a job in public, so yeah.
Yeah. So I think one of the lessons from Buffett and Munger is not just that how successful they are, how good they are, but how humble they are, how good they are at working with other people. And I think those are some of the
Yeah.
lessons. You were asking me about my mentors. Frankly, Buffett and Munger are my biggest mentors. And that is one of the reasons I go to annual meeting at Berkshire every year. And I would recommend anybody who is thinking about investing to go to the Berkshire annual meeting. And the reason is not that you will learn a lot of investment wisdom, but the reason is that you will come in touch with a lot of other people who are trying to become better at their craft, whatever that is, need not be investing,
Mhm.
right? But just to be
Mhm.
better human beings, right? And I think that is a wonderful goal that each of us should have for ourselves, to be better than what we were yesterday, and ultimately be more compassionate, more helpful, and be able to interact in a manner that is win-win for all of us. So I think that is great. And I would absolutely feel, and I feel that I am a better person for having found Buffett and Munger, and I could not recommend that highly. And so, going back to your question about who are the mentors, I think they are the biggest mentors. And I feel that I don't have to, in a world where there's so much information available, I don't really need to meet my mentors, right? If I'm just reading their books, reading their thoughts, they automatically become my mentors. And I
Mhm.
would say, Joel Greenblatt, Seth Klarman, Phil Fisher, all these greats have taught us so much, and they continue to teach us about how to live life, but also how to invest. And I think how to invest is a smaller part of it. How to live life is a much bigger part of it. And I
For
would say
sure.
that is what really attracted me to investing in the first place, because I felt the way they live their life and the way they talk is in complete alignment. And this is what I was saying when I was talking about how do I judge the management? Is it, are they walking the talk? And you see the greats, they almost always walk the talk. They might slip sometimes. We all human beings, but they're continuously pursuing that. And that is what I am trying to pursue, which is, am I telling you what I believe in? And then am I doing what I'm telling you? And that is really the whole goal.
Yeah. William Green had a great quote that said, investors are practical philosophers. And I really agree with that. And I feel like it's a field where you never stop learning, and you're actually forced into learning about things that have nothing to do with investing, but actually make you become a better person and more stable for making better decisions, which it's a great goal, in my opinion, as you mentioned.
Yeah.
um, yeah, so I have two more questions. One of them comes from a friend, which I will leave to the end. And the first one is actually, we were talking about before recording about the fact that you work from home. So I was wondering, what are the main advantages and the main disadvantages of working from home?
Right. Okay. So the main advantage is that you can be working all the time. And I love that
Yeah,
because, with investing, I typically roll off my bed, and then I'm in front of the computer doing some things. You have a lot of flexibility, but effectively, investing is a game where you don't turn on and off. You are always on in terms of getting new information, and you're trying to figure out how this information is useful. And you are just continuously taking in a lot of information. You don't know how it will be useful. And frankly, I love knowing new information. So it's a great way. But I also tell people that while I'm working all the time, I'm almost never working, right? Because
hmm,
this is fun. And when it is fun, you can work all the time and not feel tired. So that, I think, is the biggest advantage. The biggest disadvantage is the family thinks that you're not working. You're just spending, you're having too good a time all the time. So that is a disadvantage, that people don't take you
yeah.
seriously enough. No, I'm just kidding. No, I think, I don't know if there's a disadvantage. I think uh, earlier I would say work from home was seen as a disadvantage, that you don't have a formal setup and all that stuff. I don't think at this stage. I've considered, like, even if I were to have an office separately, I will have to commute to that particular office. I still will want to have area where I can sleep and take my naps, like how I do after lunch at my home.
Yeah.
So I don't understand the big advantage. One possibility is that as the team gets built out, obviously that will be something that we will do in the US. But right now, the way it works is very well for me personally, because whatever we need, we have in India, and I don't really feel I'm missing anything by working from home. So I don't see any particular disadvantage. But I will be on the lookout, David, for your next videos, to see what other people say to this question, and see if there is actually a disadvantage, or if you have come across a disadvantage, I would like to hear.
Yeah, maybe I could suggest one,
Uh-huh.
which I have been talking, actually thinking about this for someone that wants to be an investor full time, which is actually the pitfall of being bored,
Oh,
and which I believe for you is not a problem because you find it really fun. And the other one is not having the interpersonal let's say, contact on a day-to-day basis or for the most part of your day, because as everyone knows, investing involves a lot of reading and focused work. So yeah, maybe you could share your thoughts on both those topics.
Sure. So actually, you know what? Um, as our fund has done very well, and as more and as it has grown, I feel like I'm having enough and more requests for meetings. So interpersonal is a non-issue, and in fact, these days, every few days, somebody's coming over, meeting from different places. I'm like, listen, I don't want to go anywhere. If you want to meet me, come near to where I am. I'm happy to meet you.
Yeah.
Right? So
Yeah.
I think there is enough interpersonal sort of interaction that is happening, that it's a non-issue. And going back to the boredom piece, frankly, I feel I need more time to sit and read. Given these days about how much activity is going on in terms of additional interaction, I feel that the amount of time is getting squeezed. And so I don't
Mhm.
think there is any issue with boredom. When I was initially starting, let's call it when I was just starting on my own in 2016, that's when I would say that, yeah, listen, there was not as much interaction, but I never really missed it, because you can always be busy with things that you want to look at. And as you said,
Mhm.
there's always so much flow of information that all you have to do is figure out how much you want to take. So
Mhm.
it's
Yeah,
not,
yeah, yeah.
yeah,
You have infinite supply. Infinite supply. Yeah.
yeah, yeah.
Yeah, that's a really good answer, and I'll make sure to ask this question to other people, so I can send them to you.
Yeah.
Yeah, actually, before jumping into my friend's question, I would like to ask you what a typical day looks like for you.
Yeah. So typically, you know, I would wake up just before the Indian markets are closing, or maybe after Indian markets close. If I'm waking up before the Indian markets close, the first thing I want to see is, I mean, irrespective, I want to see basically how the markets were, and that's great because it helps me see, okay, what has gone up, what has not. Not because I have to do anything, but just to see how the markets have behaved. Because to some
Mhm.
extent, what the market does helps tell me what I will be focusing on for the day, if there are
Oh,
any big
cool.
moves. If there are any big moves, if they're not, like if suppose something has fallen 15-20%, it was anyway close to where I was going to possibly start looking at, then for the rest of the day I should really be spending time looking at that and saying, okay,
Hmm.
now is it closer, maybe I should be doing a deep dive on it. I mean, I might have
Right.
already done some deep dive. I'm not looking at the overall market, just to be clear. I'm looking at specific
Yeah.
stocks. I'm not
Specifics.
looking
Yeah.
at okay, what is the, because the indices may do whatever they want. We are not investing in index, we don't care about that.
Yeah.
But ultimately, if an index goes down, most probably everything goes down, and vice versa, right? So there is some impact. But effectively, once I get up, I will spend the first few hours talking to India, talking to different folks in India about things that we are doing in India, right? Because that is when the best overlap is between India and US, right? So that is India evening, US morning. So we don't want people to be waiting too long in India in talking to us. So that's the first few hours. Also, when I am sleeping in the US, that's when India is waking up. So effectively, I want to just cover the big news items and the flow of information that has come. So that I will do in the evening. And then between the late morning till early evening is when I'm doing my research, right? And
Hmm.
meeting other people that I need to meet, who are possibly in the US, right? Who wants to meet. So that is where bulk of the time goes. Of course, lunch and and nap are sacrosanct. So I think all those are part of it. But no, I think yeah. So I would say if I were to break my day, I will say maybe one fourth talking to India folks in the morning, one fourth in the evening looking at India news, and then half is sort of the research during the day.
Interesting. That's sounds like a fun day.
Yeah.
Actually, it's really cool. And what kind of talking are you doing in the morning? So is it with investors or with when you say
No,
people that you
investors don't
have out
reach
there?
out to us, and we don't reach out to investors. So our
Hmm.
investors who are already invested are very, very stable. I tell
Hmm.
them, listen, now we do once a year annual meeting. You're welcome to ask
Mhm.
any questions then.
Yeah.
And so I think we started our annual meeting from this year again, sort of borrowing from the greats. But this year I did do a lot of talking. I'm hoping that from next year I will reduce the talking and letting people ask more questions, because I was not sure how many people will ask questions.
I can join next year and ask you a ton of questions if you want.
Uh, yeah. So yeah. So I think we will see how the. But no, I think that could be interesting. So I think annual investors typically don't ask questions, but new investors are always interested. And if there are new investors, then we send them a material. If they have questions on that, we try to group a group of investors together, and we'll set up a call like this so that they can ask questions which can help other investors who are interested in knowing about the fund or whatever is on their mind. um, but investor interaction is limited. I think a lot of the interaction is more with companies visiting us, and they would want to meet fund managers. It could also be different service providers who would have different ideas that we would be happy to meet and try to understand. And the talking in India is more in terms of our service providers. It could be either if I am doing some particular interaction on the fund side, which requires interaction with our service providers in India. It could be where I'm discussing some ideas with some of the friends. It could be just taking care of India specific things, which or it could be working with the team members around research ideas. So it could be any combination of that. It's just that in the morning is when the best overlap is, so really try to keep that
Sure,
for that.
sure. Okay, so it's more of a generalistic thing.
Yeah, generalistic. I mean,
Yeah.
the day is quite flexible. We
Mm.
don't regiment it too much, other than specific meetings that we will have on specific days. But we keep it very flexible because, as I was describing, as the markets move, our opportunity set moves, and we want to be able to take advantage of the opportunities.
Nice, nice, cool. So finally, getting into my friend's question. Otherwise, he will get mad. Have you ever looked at Fairfax India? And if yes, what's your take on the business and the opportunity set
Yeah,
in
so
that
actually, I
sector?
did present on Fairfax India. I went to ValueX Whale in 2022, and you might be able to go to that and see my presentation on Fairfax
Hmm.
India. I have
Hmm.
looked at it. I think it has some very impressive holdings. The problem with Fairfax India, so first, it's a good stock. It has a good set of holdings, and obviously it's not expensive given the book value is in the $20 range and the current market price is 14 and a half or thereabouts, right? uh, I think the few things that I have seen is that it has limited liquidity, so which might not be an
Okay.
issue for your friend. And the second
Hmm.
thing is that given where the book value is and given where the market price is, Prem Vatsa, by the way, I am a shareholder both of Fairfax India and Fairfax Financial. So I
Wow,
go to
cool.
Prem Vatsa's annual meeting in Toronto. For the last
Yeah.
few years, I've been going there. And Prem Vatsa has been very keen to see how he can buy back more of the stock, but it continues to trade at a significant discount because it's just hard unless the Bangalore International Airport gets listed, and we hope it will get listed in the next year or two. That is the biggest value of Fairfax India, right? And so once it gets listed, is when we will have an independent valuation of that particular ownership of that particular holding. But beyond that, a lot of other things are listed. The initial investments that Fairfax India did was not as great. Frankly, the NCML and some of those did not work out as well. But a lot of the others subsequently have worked out well. And that is just part and parcel of what will happen with any investment operation, including Fairfax India.
Mm, interesting. And why do you feel like the opportunity set exists beside the holding company discount? And do you feel there's a good probability of the value being unlocked and the airport really being as high quality as it seems?
So first thing, Bangalore International Airport is a monopoly for the next.
Hmm.
I mean, I think they got it for 60 years, right? 30 plus 30. And so I would assume there's another 45, 50 years. I will have to see when they got that, but at least maybe like 50 years. So I think, and the way you are having arrival departure at the airport, it's very obvious to me that airport will keep growing. I think it's like 30-40 million passengers possibly, and they are planning for 90 million passengers, right? So I think there's a very significant growth path. And this year, Prem did present how some of the other airports trade. What will be interesting to see is how Bangalore International Airport trades. The way to value an airport is slightly different in the sense that the regulatory return on capital is limited by what the regulators tell them, right?
Right.
And then you have to do ancillary revenues, and I think all those should ultimately lead to good valuation. But Mr. Market is what it is, and unless there is any big event, I think the airport should trade well. That's my assessment of it, but we will have to see when it lists. I think some of the other companies that they have, I personally feel they have some good companies, some average companies, and very few bad companies, right? That's my assessment of it. So overall, it's a good portfolio. It just feels to me that it never gets the valuation that it should deserve because of the fee structure that Fairfax India has in terms of
Hmm.
how Fairfax Financial charges Fairfax India shareholders, right? And that is possibly one big negative there.
Could you break it down for me, or for the viewers, actually?
Yeah, so I think Fairfax Financial charges 1.5% of the capital deployed, and then it charges 20% over 5% simple interest, and all of that is either given as cash or that is given as shares in Fairfax India. And so the
Okay.
problem with that is that's a pretty steep hedge fund structure
Yeah.
for Fairfax India shareholders. It's good for Fairfax Financial, but
Yeah.
for Fairfax India shareholders, that has always been one challenging point. And I personally think Fairfax Financial itself owns like 43% or thereabouts of Fairfax India. I think they should do a little bit justice, or not justice. They should be a little bit more kinder to Fairfax India shareholders. They could be, not they should be. They could be, right, if they want to. It's their choice. As I said, I own both. It doesn't matter to me. It doesn't matter, but I can see why the discount continues for a reason, and
Mm.
that's the fee structure.
Nice. And at what point, or for which reasons, would you consider selling and really calling it a mistake?
No, it's so I don't. I mean, if first, you know, I think there are a few different ways of looking at it. One, do I think the management is trustworthy? Yes, there is no issue with that, right? So I don't think management is the issue. Is the business understood well? I think so. And the underlying holdings, many of them, I've done some work on it, so I understand those holdings, as I said. So I think I understand the business. I think the businesses should do fine. And then finally is the valuation. So I think on those three fronts, management, business, and valuations, I think it's fine. One of the things I will say is we should not call it a mistake, even if it does not produce returns, right? If we
Hmm.
think that our framework works and the framework says it's reasonable to continue with it, I think it's perfectly fine, even if we don't have returns, right?
Right.
Because Mr. Market has its own thought process, and we should be attuned to the market and saying what is it that they are saying. And so I'm always happy to hear other people's perspective on saying why they should not invest in Fairfax India and what are their
Mm.
concerns. But I have laid out in my mind what I think are their businesses, and most of the businesses are reasonably good.
Okay, perfect. I think that wraps up our conversation, and I had a ton of fun and learned a lot. So maybe I'll rewatch this a couple of times in the future. So yeah, thank you so much for being so generous with your time and
Yeah.
your
No, I
knowledge.
enjoyed, David. I think you asked some great questions, and I think congratulations to you for doing this at such an early stage. I think you have a huge head start on other people who are trying to get into investing. So I think congratulations on your admission in the college. You did not mention it, but I'm sure it's a good one, and look forward to talking to you in the future.
Yeah, sure. Thank you so much, and again, hope you had fun too. So,
Yes.
just before we leave, I forgot to ask you, where can people find you?
Oh, sure. So they can go to our website, which is Doordarshi Advisors. I will spell it for the folks because it's a Hindi word, so it's not
Okay.
obvious. So it's DOORDARSHI, Doordarshi Advisors.com. You will find a lot of information about us, some of the videos that I was mentioning about Warren Buffett, some of our thought processes, and so on. So I think you can go there. You can go to my LinkedIn profile or Twitter profile for that. And if you want to reach out to me, you can reach out at my first name dot last name at doordarshiadvisors.com. Happy to actually talk to people, especially if you're investing in India. Happy to chat all the time. But I'm also actively now starting to look at the US markets as well. And
Nice.
could be another interesting area that we will look at as opportunities show up there.
Cool. Perfect. So that's a wrap, and thank you so much.